I'm CAPSO's Marketing and Education Manager. Welcome to the 2014 Global Copper Market Outlook webinar, sponsored by ABC Metals. We are excited to welcome back Barbara O'Donovan. She's the Interim Managing Editor for American Metal Market. Barbara joined AMM in February 2012 from its sister publication, Metal Bulletin, where she worked for 4 years, covering a range of metals, including gold, platinum, copper, zinc, and many more. She currently oversees a team of reporters who cover the non-ferrous, ferrous, and scrap metal markets in the United States. Barbara will answer questions at the conclusion of the presentation. If you think of a question during the presentation, you don't want to forget it, then go ahead and submit it using the questions tab on your toolbar, but she will actually answer those for you at the conclusion of her presentation. As well, 1 hour after the presentation ends, you're going to receive a webinar survey. Please fill that out for us. It definitely helps us plan future CAPSA webinars for you. If you have webinar topic ideas or speakers you'd like to hear from, the survey is really the place that you can give us that information. Whenever you're done filling out the survey, there's going to be a link to Barbara's slides from today. As well, we are recording the webinar, and you're going to receive the recording of that via email. We'll also have it on our CAPSA website and our YouTube channel. So if you want to pass it along to others, let them hear. If they missed the webinar today, then feel free to share that link with them. Without further ado, I would now like to turn the presentation over to Barbara O'Donovan.
Thank you very much, Carly, for the introduction. I'm just going to select the screen here so you're all going to be able to see what I'm doing. Okay, many of you are probably familiar with American Metal Market, or AMM as we like to say, but for those of you that are not, it's a daily subscription service that provides news and prices to the non-ferrous and metals industry, non-ferrous and ferrous metals industry. We've been around for over 130 years, and we're based in New York, so I will forewarn you now, if you hear sirens, I'm not being arrested. It's just impossible to avoid in this city. As well as New York, we have an office in Pittsburgh. We've got reporters based in Pittsburgh, Chicago, and also on the West Coast. So we're also part of a much bigger company, and that's why the presentation I'm about to give you today was prepared by a colleague of mine, Andy Cole. He works at our sister company, which is Metal Bulletin Research. MBR, we like our acronyms around here, is a provider of market analysis and price forecasting for the metals industry. So AMM doesn't price forecast, but MBR does. So what I'm telling you now is all on behalf of MBR. So moving through the presentation, I have to show you the boring and obligatory disclaimer slide. This essentially just tells you that the information I'm providing you with is intended for informational purposes only, and it's not intended for trading purposes. We also would just like to highlight that MBR has a weekly base metals market tracker, and that basically ensures that the analysts are tracking everything that's going on in the market. So for more information on that, it's available online and sent to you directly. Please go to metalbulletinresearch.com if you'd like to know any more. So with the free publicity bit out of the way, I'm going to keep going and get started. I know most of you will probably be listening out just for the price forecasts, but I am going to ask you to be patient whilst I take you through the journey we took to arrive at them. This slide shows you a synopsis of my presentation. First, we're going to look at copper supply. Next, we'll delve into the outlook for the global economy and copper demand. And then we'll take a look at investment fund flows in and out of copper. And then we'll get to the Holy Grail, the price forecasts. So in contrast to when I was talking to you this time last year, hopefully you're all back and listening to me again, our analysts believe we're in a new era in terms of supply. The top 10 mining companies are growing production strongly, and if you look at the chart on the left of this slide, you'll see that there have been double-digit year-on-year quarterly increases lately. We've all, heard for the last few years about declining concentrates at the mines, mostly due to lower ore grades. But after more than a decade of global mining capacity utilization rates being pretty low, they've bounced back, and that you can see a little bit more from the chart on the right. If you take a little bit of a closer look at this chart, the top line represents mine utilization rates, whilst the lower, slightly lighter blue, I hope you can see that, represents the refinery capacity utilization rates. As you can see, I think it's worth pointing out that the refinery capacity utilization rate hasn't seen the same steep increase that the mines have at that lower end of the right-hand side. You see that top line really taking a steep move upwards, whereas the low one, it's beginning to move up, but it's not quite there. So the higher concentrate level might not necessarily translate to equally higher supply of cathode. Some market players said operating constraints at smelters and weaker scrap supply will weigh on the refined output despite this upturn in concentrates. Moving on to my next slide, after several years of, several lean years, miners have improved the reliability of old mines. It's not that those lower ore grades have gone away. They've either improved reliability or there's new mines coming online. So the era of underperformance seems to have passed, and annual unplanned copper mine disruptions have decreased. Obviously, there's one notable exception this year in the domestic market here in the US. We had the wall slide at Kennecott, Utah Copper, but despite that, what our analysts are seeing is an increased supply of concentrates. Supporting this argument is the soaring treatment and refining charges that you can see on the right-hand chart. In TCRCs, again with the acronyms, they represent smelters, what smelters charge to turn concentrates into metal, or alternatively, what those smelters or traders deduct from the copper price when buying concentrates. Just this week, we're getting reports of BHP Billiton offering TCRCs of 9.5 cents per pound to Japanese customers for the first half of 2014. And that's even higher than the 9.2 cents per pound agreed by Freeport-McMoRan with Jiangxi Copper earlier this week. I believe that's now kind of fully confirmed. Jiangxi Copper have come out and said that today. And that's a level that we haven't seen since 2006. That's at 9.2 cents per pound. To put that into context, by contrast, the market this year followed annual terms of 7 cents per pound in 2013. So that's quite a step up. Essentially, TCRCs have increased due to the greater availability of copper concentrates that has resulted from the higher production at the mines that we were just talking about. So we've got this concentrate glut. So I guess what we all want to know is whether this concentrate glut will translate into a cathode glut or a cathode surplus. And when we're trying to look at the concentrate surplus, and its relationship to the refined metal surplus, we need to look at the Chinese smelters. There's just no avoiding it. As you can see from the chart on the left, Chinese imports of copper concentrate have risen by 30% this year. That indicates that smelters are most likely holding high stocks of concentrates on the ground. But at the same time, we're also beginning to see indications that they're now dipping into those stocks. Looking at the chart on the right, you can see that upward trajectory that I'm talking about. Chinese refined copper production has reached record highs in September and October. And that really does indicate that all those concentrates that are being sent over there and all that extra production of concentrates domestically in China is starting to move into the refined market, the copper cathode market. So just how quickly will the concentrate surplus be transferred into the refined market? That depends on how aggressive the Chinese smelters decide to be. The high treatment and refining charges that we talked about earlier are an incentive for mines to produce even more concentrates, and new capacity continues to be added in China. So the MBR analysts, they're forecasting Chinese production to grow by 17% in 2013 and 12% in 2014. Part of the reason I think this is particularly significant to the market here as well is that we've been hearing for many months now that material is moving from traditional routes, so that would have been originating in South America and making its way here to the US. We've seen that a lot more of that is going towards China. The premiums have something to do with that as well, but premiums in Shanghai have remained relatively strong. Shows that demand is keeping up so far. I think right now we've got a Shanghai copper cathode spot premium at 8.8 cents roundabout. That compares to just under 2 to 3.5 cents at the start of the year. So up until lately, a shortage of copper concentrates and copper scrap has kept Chinese refined production in check. But with the concentrate supply now rising, the risks are to the upside, meaning the risks to prices are to the downside, unless demand is strong enough to absorb the build of the supply. So the build of the supply, if demand comes up and meets all that extra supply, we're fine. But we've got to wait and see. So let's take a step back from China. Let's take a look at the global economy and copper demand. As you all know, the global economic outlook and sentiment in general is having a greater impact on copper prices in recent years. It's no longer just the fundamentals that people are relying on. Supply and demand are the essential fundamental indicators, but the weight of sentiment cannot be ignored in the current market. China is still a key factor. We can't take away from the fact that it accounts for 40% of copper consumption, and copper's fate is intertwined with the economy there. Been some concerns about the slowing economy in China, but our analysts generally believe the negativity is misguided. Chinese policymakers have demonstrated that they can step in and overcome problems. They're very good at assessing the situation and going, okay, we're going to change this rate or change that rate, and let's get back on track. So we've had, while there's a generally bearish focus on the negative risks like leverage, overinvestment, bad debts, we again believe that is misguided. We think the economy in China will continue to demonstrate strong forward momentum, and though growth will slow down to about 7%, there's still growth there over the next 5 to 10 years. So here we've got some slides on the economy. As I said before, the growth may slow down, but it'll maintain strong forward momentum. The chart on the left shows MBR's forecast for Chinese growth through 2013. And the chart on the right is probably the slightly more interesting one. If you turn your attention to that, you can see that it's the copper supportive infrastructure investment that we're interested in. It'll remain very important in the current 12th five-year plan in China. We're set to see a huge boost in social housing under the current plan, as well as investment and rail and power. So all these things should support copper demand there. And again, we'll bring it back to home. We have seen metal not coming to the US and going to China instead. So this is why I'm focusing in on just what are the expectations from that economy. So with that last slide in mind, detailing where the copper is going to be needed in the various infrastructure investments, our analysts expect Chinese apparent consumption is on course to rise 10% year on year, but they have flagged up a note of caution that growth may be close to peaking if we're looking back at historical trends, looking at that chart on the left. We're coming up to a peak right now at the end of that line is going. Look back, the last few times it's happened, we've had a little peak up here and then we've come back down again. So we're just flagging up a note of caution that that could still happen. But if we're looking at the charts on the right and the top one detailing semis production, look at the most recently available data, semis production, which is taken as a strong indicator of actual consumption in China. That's up 20% this year. So it indicates, again, that it's a strong demand. And the reason why I'm saying we need these sorts of indicators is because this time last year we were also talking about a lot of copper going towards China. But what we were seeing in that case was it was going and sitting in warehouses, and there was this build of inventory. So the indications that we get from the semis production number and the bonded warehouse stocks below, they're more important because they show what theoretically, hopefully, is real demand. So stocks in the bonded warehouses, they've gone down. Generally speaking, the rule of thumb is you need, the stocks come down when people need metal. Of course, we've had instances where it's been moved to other warehouses. We believe they've come down on real demand. And, that's happened through most of the past year, and they're yet to rebuild. It's another sign that demand is good. So looking at, how does the China picture line up with the global outlook? Our analysts at MBR expect refined copper consumption to grow in line with historical rates. We're not expecting anything huge. We expect demand growth of 3.3% for the period between 2010 and 2020. That compares to 3.1% in the decade previously from 2000 to 2010 and 3.1% in the average annual growth in the 40 years before that. Of that consumption, China's share of global demand or global consumption is currently 45%. I think we had that of 40% this year. We definitely seem to think it's gone up quite a bit. We also expect that to continue rising. We expect that to rise to 55% of global consumption by 2020. So it just can't be ignored. If we were to look at things a bit closer to home, I think it's a good thing to go and look at the copper and brass semis, the production here in the US. It's been mostly better than this year than last year, as you can see from the chart on the left. Output of copper plate, sheet and strip, as well as tubes and wire has increased. As you can see, from the light blue color is the 2013 year-to-date section, and the dark blue is the 2012. We've only seen a decrease in rods, bars, and sections. Our analysts expect refined copper consumption to grow 3% this year. That's here in the US, driven by demand particularly from the automotive and residential construction industries. We think consumption is likely to continue to grow, but it's going to go at a potentially slower pace, at about 1.5 to 2% in 2014 to 2015. So things things are looking relatively good. We're not forecasting a dip. We're not necessarily saying it's going to go crazy either, but the main thing is we're expecting demand to increase here. So now let's take a look at investment fund flows. Investors have been a growing part of the copper market for some time, and however much we may want to ignore them, they do have an impact. It's worth noting actually this time last year I was speaking to you and I was saying that we were kind of facing this imminent threat of exchange traded funds. I think it's probably the elephant in the room to say, well, that didn't happen. As much as I think there was definitely a play to say they wanted to get new people off the street investing in copper, I think the growing regulatory environment over the past year, the increased focus on the LME and the stocks and the warehousing rules that we've seen, particularly in the last few months, somehow led to that ETF idea completely falling away. So while it was huge for me this time last year, I'm not even going to talk about it this year. So let's take a look at the net speculative positioning in COMEX copper. The chart on the left shows how positions, they really do pull the price up or down. No matter how much we want this to be, the price movements to be just about the fundamentals of supply and demand, the investors do make a difference. The thinner dark blue line, it relatively charts that the blue areas represented by the investors' net positions. It really does drag things up and down. So what you have now towards the right-hand side of the chart on the left, if that's not confusing enough, investors are net short. They've pared back their exposure this year. However, it's much closer to neutral now than it was over the summer or the start of this year. If you look at the chart on the right, it shows that there was a big move out of commodities earlier this year. But as we know, the market is cyclical, so it's worth noting that we could be set to see a return. They go away, they decide something else is prettier for a while, and suddenly the attention will be back to copper. It happens cyclically all the time. So we do think that investors, essentially all the bad news has been fully priced in by investors. So there's leaving some room for positive positioning adjustments. And so we move on to the moment I think you've all been waiting for, and that's MBR's copper price forecast. It's one of those moments I wish I had a drum roll. Copper prices have remained relatively resilient recently, despite other metals having drifted lower in recent weeks. We've said quite recently that we've expected copper would either stay strong and drag the rest of the base metals complex back, or be pulled down itself. And despite plenty of reasons not to, despite supply shortages, higher premiums, stronger fundamentals, copper prices, they took the latter path. They went down, and they probably gave way last week. And so given that slide in prices, MBR revised its copper price forecast just this week. So for 2014, we're now looking at a base case of $3.24 per pound, so that's an average across 2014, with a bear case of $2.99 per pound and a bull case of $3.54 per pound. This compares with a forecasted average price of $3.33 per pound. It could possibly seem a bit contradictory at this point, because I think we've pointed out a lot of bullish factors for copper going forward, and yet here we are saying, well, we actually expect the average price to be lower. We do continue to forecast a surplus in 2014. While we have decreased that, it's now at 218,000 tons in 2014. This price revision was not about the fundamentals. It's more about sentiment. The market is simply not as bullish as we had previously anticipated, and prices in 2014 will be starting from a much lower point than we previously forecast. So our 2014 forecast had to come down. That said, it's worth turning back to the physical market and looking a bit closer at the US in particular. It's where you're focused on yourselves, your industry. The demand outlook here is solid for copper. The US economy is expected to maintain a modest growth rate. Like I said, automotive and residential construction are expected to be areas of positivity for the year ahead. Spot premiums are ending the year at high levels. Supply remains relatively tight, and we've got things that happened this year, like Kennecott. They're not talking about coming straight back into the market, so we foresee the supply situation remaining relatively stable. And another indicator of that kind of bullishness is, from what we hear, negotiations that are already underway for 2014. Annual contracts, we're hearing higher numbers. The stocks in the warehouses also continue to be low. So all in all, it's a bullish feeling from MBR on copper, its fundamentals, although we do expect the prices to be slightly lower next year. So I've added a slide here to give you my contact details. Please feel free. It's always a task when you're trying to create a presentation for an audience you can't see. You're wondering, well, I wonder if they'd like this or that. So there's lots more information on hand. So you've got my number there. You've got my email if you want to come back to me, or feel free to ask me any questions now. I've also put in the details of Andrew Cole. He's our senior metals analyst at Metal Bulletin Research. He's got a British number that's there with the 0044. You would need to put a 011 ahead of the 44 to dial out of the US, and his email is also there. So any further questions, please feel free to ask them now or contact me later on.
Thank you, Barbara. Yes, go ahead, everyone. Send your questions in using your webinar toolbar if you have any. We do have one question, Barbara, for you. If you can answer, what are semis or semis?
Semi-finished products.
Okay.
I hope that answers the question.
Yeah, they can. Didn't have too much detail. So, well, Barbara, we always really appreciate having you here, annually to give us the outlook for, the year to come, and it's wonderful information. So, it looks like, let's see. For 2015, do you have any market comments? Do you have any ideas about what 2015 is going to look like?
I have been mostly focusing on 2014. I know that's very short term, but I know we have some, we do have some price forecasts in place. Obviously, take everything with, we don't know what's going to happen next year, but I think we're looking at a base case scenario for 2015 of $3.23. That's almost unchanged for what we're expecting from 2014. In the high case scenario, that would we've got a $3.63 per pound price level. That would assume extensive supply cutbacks, keeping stocks at much lower levels than in previous downturns, and it would also assume an aggressive price response in a very tight market when demand returns. We also have a low case scenario. It's $2.86, which is lower than what we're forecasting for 2014. That would assume a deeper, longer, recession returning and demand destruction. It would, you'd be looking at falling production costs, reducing the necessity to cut supply aggressively, allowing a tightness to unwind and for longer, and stocks rising higher. So base case scenario, we're pretty much in line with 2014. We do see a little bit more volatility towards kind of upside and low side. So I guess that would account for not being quite sure what will happen next year. It's like this year. Did any of us foresee the wall side of Kennecott? No. This time next year, tune in and I'll hopefully tell you a bit more about 2015.
We have a couple more questions. Will the mini COMEX contract remain in effect or will it go away?
It's a good question. It's one I think I'll have to decline to answer simply out of it's not really been talked about a lot in my conversations. Whether you take that as an indicator to say nobody's paying attention, or whether you just say maybe I'm having the wrong conversations, I'll leave you decide that. But it's not something I'm fully versed up on right now. Okay.
And maybe we have a final question here, unless anyone wants to send in a couple more. What countries do existing copper mines expect lower production?
What countries? Okay. I know it's an answer I don't have a definitive answer for right in front of me, but thinking about some of the issues that are cropping up right now, I think there are some, political issues out of Mongolia that are clouding some of the expectations for next year potential production. You've got an election coming up in Chile as well. I think some people have said, what will the knock-on effect be for production there? Will the new powers that be, will they be enthusiastic about mining? I think the long and short is that, copper, it's a huge contributor to Chile. People, nobody's going to come in and say, right, you need to cut everything now. So we're not expecting a huge decrease out of South America. Europe, in general economic terms, we're expecting things to go on at a pretty even keel, so I don't think we're expecting a decrease in production there. So I guess my immediate answer is right now I don't have an immediate red flag saying, definitely such a place production will be down. But if somebody wants to send me an email, I can look into it a little bit further and get some further detail.
Okay, perfect. What would prevent copper prices going below $2 again or ever?
What would prevent it? So I suppose we need several things to stay in place. I guess we need demand to continue as it is, or continue as we expect it to get stronger, and consumption levels to go further. Another recession could prove, would obviously drag things down, but I don't think anyone is forecasting that right now. No one's saying times are rosy and sweet, but we don't see us drifting back down there. As long as demand stays up, as long as supply stays relatively tight in the way we're expecting it to. These days, most copper mines or miners are very keen to tell you, they've got their mine coming on stream. So there's a huge amount of information out there when you go into making these forecasts for it. surpluses or deficits, so we're talking about a surplus for next year. So I don't think we're going to see any surprises. However, again, let's talk about kind of, there will always be the unforeseeable things. But I don't think we're in a situation where supply is going to increase so much that it's going to be really swamping demand in such a way that we will move back to that below $2 level. We seem to be very much, happy in this $3 level. I could be eating my words this time next year, but I don't think we're in any danger of drifting back down there.
Good. Okay, good deal. Well, Barbara, again, thank you so much, and thank you to our sponsor, ABC Metals, for sponsoring this presentation. And if you want to find out more about ABC Metals, go to abcmetals.com. Find out a little bit more about them. But if you have, like Barbara said, if you have any further questions, you think of something after the presentation, you want to follow up with her, feel free to shoot her an email or Andrew Cole an email, and they'll be more than happy to answer, any questions that you have. Again, go ahead and fill out the webinar survey. You'll receive that here in about an hour. Let us know any more webinar topics or, anything else that you would like to see from us. And we appreciate you all being on the call. Thank you again thank you for joining us, and thank you, Barbara. We appreciate it.
Thank you, Gardy.
All right. Bye-bye.